You pay it every single month. Car insurance, home insurance, health, life, renters, quietly draining your account year after year. And here's the part that should make you angry. A huge number of people are overpaying right now for the exact same coverage, simply because they don't know a few things the industry would rather keep quiet. Insurance companies make money two ways: by collecting as much as they can in premiums and by paying out as little as they can in claims. Everything else flows from that simple fact. Today, I'll show you 12 insider tricks, some that can lower your premium almost overnight, and some that protect you when it's time to actually use the insurance you've paid for. Stay with me, because the secret at number 4 could sink your entire claim with a single sentence. And number 1 is the reason your loyalty is quietly costing you a fortune. Here's the mindset that ties all 12 together. Insurance companies count on one thing above all else: that you'll do nothing, that you'll let the policy auto-renew, never compare prices, never ask questions, and never push back on a claim. Your inaction is their profit. So almost every trick on this list is really about the same move: taking back a little control with a phone call, a question, or a few minutes of attention. Let's start with the easiest money you'll ever save. Number 12. The quote you never get. This is the single most powerful money-saving move in the entire insurance world, and most people never do it. They get one policy, years ago, and simply let it renew forever. Meanwhile, the market keeps moving without them. Here's why this matters so much. Insurance pricing is cyclical. At any given moment, some companies are hungry for new customers and willing to charge far less for the same coverage. Studies have found that people who gather several quotes and compare them often save somewhere around 20 to 30% compared to just sticking with their first option. That's not a small discount. That's potentially hundreds of dollars a year for the same protection. So once a year, get at least 3 fresh quotes for the same coverage you already have and compare them honestly. The companies are betting you're too busy to bother. Prove them wrong, and you may pocket the easiest savings of your life. And while you're shopping, you might be leaving even more on the table because of discounts you were never offered. Number 11. The discounts they don't mention. Insurance companies offer a whole menu of discounts that can meaningfully lower your premium, but here's the catch they're quiet about. Many of these are not applied automatically. If you don't ask, you simply don't get them. Think about how many you might already qualify for. A good driver discount for a clean record. A low mileage discount if you don't drive much. Savings for completing an approved defensive driving course. Discounts for anti-theft devices or safety features on your car. Good student discounts. Each one sits there, available, but the company has little reason to remind you, because every discount you miss is money they keep. So call your insurer and ask one direct question. Please list every single discount I might qualify for. Then go down the list. You may find hundreds of dollars hiding in discounts you were eligible for all along and never knew existed. And there's one big discount that comes from simply combining what you already have. Number 10. The bundle bonus. If your car insurance is with one company and your home or renter's insurance is with another, you may be quietly losing money every month. Insurers love it when you keep everything under one roof, and they'll often pay you to do it. It's called bundling, and the reason it works is simple. A customer with multiple policies is a loyal, lower-effort customer who's less likely to leave. To reward that, companies frequently offer multi-policy discounts, commonly somewhere in the range of 10 to 25% off the combined cost. On your total yearly insurance bill, that can add up fast, so ask your insurer what you'd save by bringing your policies together. One caution, though: don't bundle blindly. Compare the bundled total against keeping them separate, and never add coverage you don't actually need just to chase a discount. When the math works, bundling is one of the easiest wins there is. Now, here's a lever you control completely. Number 9. The deductible lever. Your deductible is the amount you agree to pay out of your own pocket before your insurance kicks in on a claim, and it's one of the most direct controls you have over your monthly premium. Most people just never touch it. The relationship is straightforward. The higher your deductible, the lower your premium, because you're agreeing to cover more of any small claim yourself, so the company takes on less risk. Raising your deductible can noticeably cut what you pay every month. But there's a trade-off you must respect. If something happens, you'll need that larger amount available to pay before coverage begins. So consider raising your deductible to lower your premium, but only if you have enough set aside in an emergency fund to comfortably cover it if a claim ever comes. Done wisely, it's a smart, instant saving. Done carelessly, it's a trap. And speaking of leverage, here's a move that works even on the company you already have. Number 8. The leverage call. You don't always have to switch companies to pay less. Often, you can lower your bill with the insurer you already have, using one simple thing as leverage, a better offer from somebody else. Here's how it works, and why it's so revealing. Get a few competing quotes first, then call your current insurer and tell them you've found a lower rate elsewhere and ask what they can do to keep you. Very often, a discount suddenly appears out of nowhere. And think about what that means. If they can lower your price the moment you threaten to leave, that lower price was available all along. They just never offered it because you never asked. So use real quotes as a bargaining chip with your existing company. The savings they find for you are simply the savings they were quietly keeping for themselves. And that hidden savings idea leads straight into a trap that grows the longer you stay still. Number 7. The set and forget trap. Most people set up an insurance policy once and never look at it again. It just renews, quietly, in the background, for years. And that set it and forget it habit is exactly what the industry is counting on, because your life changes, but your policy usually doesn't. Here's what slips through the cracks. You might be paying for full collision coverage on a car that's now old and barely worth it. You might be carrying add-ons you've long forgotten. You might be paying monthly when paying the year up front would cost less. None of it gets fixed unless you look, because the company has no reason to suggest you pay them less. So once a year, read your policy line by line. Drop coverage that no longer fits your life, ask whether paying annually saves you money, and trim anything you don't need. A yearly audit keeps you from paying for a version of your life that ended years ago. Now we cross into trickier territory, where the company wants something from you. Number 6. The tracking trade-off. You've probably been offered this one, a program where you install an app or a small device that monitors how you drive in exchange for a possible discount. They make it sound like free money. It's not quite that simple. These usage-based programs, sometimes called telematics, really can lower your premium if you're a calm, low-mileage driver. But here's the part they downplay. The tracking cuts both ways. Hard braking, late-night driving, lots of miles, or quick acceleration can be logged. And in some programs, that information can keep your discount small or even push your rate up. You're handing them a detailed record of your every drive, and they decide what it's worth. So before you opt in, ask the key question. Can this program only lower my rate, or can it also raise it? If your driving is gentle and your mileage low, it can be a real win. If not, you may be volunteering for a penalty. Know which driver you are first. And once a claim actually happens, the game changes completely. Number 5. The lowball first offer. This is where the second half of the business shows itself. You've paid your premiums faithfully for years. Then something goes wrong, you file a claim, and the first offer that comes back is surprisingly, disappointingly low. That is rarely an accident. A low first offer is a deliberate strategy. The company is betting that you're stressed, that you need money quickly, and that you'll be relieved to accept almost anything. It's a way of testing whether you'll settle for far less than your claim is actually worth. Many people, exhausted and unsure, simply take it and leave real money on the table. So treat the first offer as a starting point, not a final answer. Gather your own estimates, document everything, and don't be afraid to push back or ask exactly how they reach that number. A polite, firm, "This doesn't cover my actual loss," can be worth thousands. But be very careful how you communicate, because of the trap at number 4. Number 4. The sentence that sinks your claim. Remember I promised one secret could sink your whole claim with a single sentence? Here it is. After an incident, an adjuster may call you, friendly, sympathetic, and ask to record a statement about what happened. It feels routine. It can be one of the most dangerous moments in the entire process. Here's the quiet truth. Recorded statements can be used against you later. An offhand, harmless-sounding comment, "I'm okay," or "I didn't see them," or a guess about details you're not sure of, can be replayed and reframed to suggest you weren't really hurt, or that you were partly at fault. The same goes for signing broad medical releases, which can let them dig for any reason to reduce your payout. So if you're ever asked for a recorded statement, slow down. Stick to simple, known facts. Don't guess, don't speculate, and don't minimize your situation to be polite. You can always say you'll follow up in writing once you have the details straight. Careful words protect your claim, and careless ones are exactly what the next tactic is designed to pull out of you over time. Number 3. The wear you down game. When a company doesn't want to pay a claim quickly, it has a quieter weapon than a flat no. It's delay, slow, grinding, exhausting delay. And it's used on purpose, because a tired claimant is a cheaper claimant. Watch for the signs. Being asked for the same documents over and over, new paperwork requested in dribs and drabs, one piece at a time, when they could have asked for it all at once. Calls and emails that go unanswered for weeks. Your file mysteriously passed to a new adjuster, forcing you to start the whole story over. A tactic sometimes called churning. Even lost documents you have to resend. None of it is random. It's designed to frustrate you into giving up or settling for less. So protect yourself by keeping detailed records of every call, every name, every date, and every document you send. Stay calm, stay organized, and don't let the fatigue push you into giving up a claim you deserve. Persistence is the counter to delay. And these delay tactics are actually part of a bigger, named strategy, which brings us to number 2. Number 2. Delay, deny, defend. Inside the industry, there's a pattern so well known it has a name, the 3 Ds: delay, deny, and defend. It describes a strategy some companies use to hold on to money they may actually owe. Once you know it, you'll recognize it instantly. First comes the delay we just talked about, to wear you down. Then, if you persist, comes the denial, sometimes based on vague policy language they won't fully explain, or by blaming you for not providing information they may already have. And finally, the defend. If you still push, they're prepared to drag the matter out, betting that most people won't have the energy or resources to fight a large company. It's not always personal. To them, it's simply math. They stay profitable by paying out less than they take in. So if your claim is being delayed or denied, understand that this may be a known strategy, not a reflection of your worth or your honesty. Request written explanations, cite your policy, keep records, and for a serious claim, don't hesitate to seek professional help. Recognizing the pattern is the first step to beating it. And now, the biggest secret of all, the one quietly draining you every single year. Number 1. The loyalty tax. Here it is, the secret that should genuinely make you angry, because it punishes the very thing you thought was a virtue: loyalty. You'd assume that staying with the same insurer for years would earn you a better deal. In many cases, the exact opposite is true. It's known as the loyalty penalty or the loyalty tax. Some insurers quietly raise the rates of long-term customers year after year, counting on the fact that loyal people don't shop around. New customers get the shiny, low introductory prices, while the faithful ones who never question their renewal slowly pay more and more for the same coverage. And remember the leverage call from earlier? The fact that they'll suddenly offer you a discount the moment you threaten to leave is the proof. The lower price was always there. Your loyalty was simply being taxed. So here's the mindset that ties this whole video together. In insurance, loyalty without vigilance